A home equity agreement, HEA loan, sometimes called a shared equity agreement, is a financial product that allows homeowners to access the equity in their home without taking on debt, monthly payments, or interest. Instead of borrowing money as in a traditional loan, you receive a lump sum of cash in exchange for a share of your home's future value. Here's how it works. A financial institution or investor provides you with a cash payment upfront, typically based on a percentage of your home's equity. In return, they agree to share in the appreciation or depreciation of your home's value when you sell the property or end the agreement. HEA loans generally have a term of 10 to 30 years, during which you can sell the home, refinance, or buy out the agreement. Let's break it down with an example. Suppose your home is worth $500,000 and you have $300,000 in equity, the home's value minus your mortgage balance. You enter a home equity agreement for 10% of your home's value and receive $50,000 upfront. When you sell the home 10 years later for $600,000, the investor takes 10% of the sale price, or $60,000, as their share. If your home's value decreases to $400,000, the investor takes $40,000, sharing in the loss. The biggest advantage of an HEA loan is that there are no monthly payments or interest charges, making it an attractive option for homeowners who are cash-strapped or don't want to take on additional debt. It can be used for various purposes, such as home renovations, paying off debt, or funding major life expenses, without impacting your cash flow. However, there are some key considerations and risks. Equity loss. You're giving up a portion of your home's future value. If your home appreciates significantly, the investor benefits from that growth. Costly if home values rise. If your home's value increases substantially, the amount you owe to the investor at the end of the agreement could be much higher than the cash you initially received. Fees. Many HEA loans include upfront fees, such as appraisal or administrative costs, which reduce the net amount you receive. Let's use another example. If you take a $100,000 HEA loan on a $400,000 home, and your home's value doubles to $800,000 during the term, you would owe the investor their agreed-upon share of the appreciation. If the agreement was for 20%, you'd owe $160,000, 20% of the $400,000 appreciation, plus their original share of your home's value. HEA loans are best suited for homeowners with substantial equity who want to access cash without increasing their monthly obligations. They can be a good alternative to traditional home equity loans or HELOCs, particularly for retirees, self-employed individuals, or those with lower credit scores who might struggle to qualify for traditional financing.